the final part of our one-day business course, and that is financing your business. So I'm going to be talking about stuff like different tax structures within a business, how to have a go at a cash flow forecast, different options for financing a business, all that fun stuff. It's going to be a bit heavier on the maths, so I hope you're ready for that. Here we go. Right, so startup finance. The money you need in order to get your business to the point of trading. There are lots of different options in terms of trying to, to get this money together, but the first thing you need to know before you pursue any sort of finance options is how much do you need? What are my startup costs? In any case, whether you're applying for a loan, whether you're using your own finance, whether you're trying to find a grant if possible, you need to know exactly how much you need in order to start to even get started on those processes. So make a list of all of the things you need to start the business. This could be things like insurance, this could be things like equipment, this could be materials for stock, and get an understanding of what your startup costs are. So different options for financing a business. The first one on our list is self-finance. Now this is you being, and this is an ideal scenario where you already have the money and income you need to start the business, and you invest it yourself. This option is very convenient if it's possible for you. Obviously it's not possible for everyone, but it's a very convenient option. It's hopefully lower risk than other options such as loans, and it also affords you convenience in that you don't have to put lots of applications together, and it also offers you a lot of control. Being able to finance the business yourself means that you are in complete control of the business. Not in every scenario, but in some scenarios, taking in money from an outside source into the business will also be sort of selling almost a bit of control of the business. And it's always a very good idea to, in any scenario where you're borrowing money or trying to get money from any other source, whether that is a loan provider, whether that is a family or friends, more or less, especially if it's family or friends, someone close to you, maybe a potential business partner, maybe a potential investor. Any money coming into and out of the business, first and foremost, needs a paper trail. So there needs to be some sort of documentation, some sort of written agreement about that money coming into the business. And it's also incredibly important for you to understand what the expectations are for that money. So if say your mate says, yeah, I'll help you out with your business, here's £500. You need to understand before accepting that money. Right. Oh, brilliant. Okay, so you're willing to put £500 into the business. What are the expectations of this? Is this a present to me? Is this something you're expecting back? Or is this essentially just money you want to put into the business, but you are also now wanting some control over the business? Or maybe is this an investment in the business? Are you expecting some profits back now that you've given me this money? If this is a loan with no expectation of control in the business, or of no expectation of getting any sort of profits from the business back, are you expecting any interest on the loan? Are you expecting it to be paid back by a certain date? Are you expecting sort of payments over a certain amount of time? Are you expecting any say in the business? Now that you've given me this money, are you expecting to have decision-making power within what I'm doing? All of that just needs to be laid out, and if possible, in writing at the earliest stage possible. Any money coming into or out of the business. So the reason that is important is that everyone knows going in what is expected of them, and if they are to expect the money back, if they're to expect any additional money back, or if they are trying to invest in the business, it all needs to be laid out in writing. It's the best way to make everything clear for everyone. So next up is a bank loan, which is another option for financing a business. Obviously, any instance of you getting into debt is one that you want to avoid. So if you have the option to not take out a loan, obviously that is preferable. Loans will often, even for business purposes, especially starting off in a new business, there will usually be your personal loan, so for business purposes. So it will still be a loan that you are responsible for, that is debt in your name, not necessarily your business's name. Now, there are some scenarios where a business can take a loan out, and that be sort of separate from the owner of the business. So, for example, a private limited company with its own separate bank account, and it being its own legal entity, can often receive a loan from the bank in that legal entity's name and not in the sort of the owner of the business's name. That is possible. That is one of the perks of a private limited company. Of a limited company. The sort of responsibility, like the finance is limited to the company, and the responsibility is limited to the company. However, it's very likely in a new business that you'll be asked as the owner of the business to essentially be a guarantor on that loan. So effectively, still a personal loan that you're responsible for. You need to have a good understanding. If you are going to take out a loan from the bank, then you need to understand what sort of interest they'll be charging you, what sort of payments they'll be expecting, what is the payback period. So a lot of the time, it may be they expect that amount to be paid back over a certain number of years, maybe 2 or 3 years. In in the case of larger amounts of money, maybe more than that. One sort of source of startup finance in terms of loans is the Startup Loans Company. They offer between £500 and £25,000 startup loan that you can apply for. It requires a business plan for you to do so, and as I say, is still a personal loan for business purposes. So it's still a loan in your name that you're responsible for. Again, it comes with interest rate APR of around 6.2%. So all of that worth taking into consideration. Also, a loan is often essentially not a good idea, or not a feasible idea, or one that you can pursue if you don't have the right credit history. There are most loan companies will have an automated system in place that checks your credit history before you can proceed with an application. And if it's not great, or if you got missed payments or anything like that, it will just be an automatic no without someone even looking at your application. So in some cases, that's an option people can sort of pursue. In other cases, it's an impossibility. Business grants are great when you can get them. Absolutely great. So a grant is you receiving money that you don't have to pay back, whether that's from a competition such as our Sustainable Startup Award, where you apply for a grant and can receive it, whether that's various awards you can get, or sometimes government grants and things like that. I will say grants are very, very, very thin on the ground, and there's very high competition to get the grants that are about. Over the past 10 or so years, there used to be quite a lot of business grants available. That has now switched over to business loans. So they're very thin on the ground. They're not very easy to rely on. And usually they're quite specialized as well, quite sort of topical. A grant may be applicable to so the grants available sort of may change with sort of trends in the marketplace. So for example, you may be able to receive money for Brexit preparation fund, or sustainable businesses as well. It may be, in order to be eligible for quite a lot of the grants available, you have to be in quite a specific sector. One thing I will say is that a fantastic resource in trying to understand the funding opportunities in the Northeast particularly is a website called Northeast Growth Hub. It is a website where they've collated all of the funding and business support opportunities in the Northeast, and that is updated quite regularly. Obviously as well, it's worth keeping an eye out on grants in particularly in response to this pandemic we're currently in. There has been some support that has been hinted at from the government in order to help businesses get through this time. One thing I will say is, looking at it, it seems to be mostly aimed at already established businesses. rather than businesses wanting to start up. So if you're aiming to start a business rather than continue or grow a business, you may find less support in that area, but always worth keeping an eye on, because you never know what you'll be able to get out of that if there is support available. But yeah, so as I say, before you want to pursue any of these finance options, you need to first understand how much money you need to get in order to start your business. Make a list of the items that you already have, that you've already got for business purposes, and make a list of the items that you do need to start the business. So, for example, this could be you might in order to run the business, you might need a laptop, you might need certain equipment. If you're working in construction, you may need a van, you may need a certain type of tools, or anything like that, as well as maybe stock, as well as perhaps a website or set up on social media. And some of these things may be free of charge, and some of these things will cost something. And also different types of insurances may be applicable. So you wouldn't be able to start driving around in your van without being insured for business purposes. So all of those are examples of startup costs. So everyone should be able to make a list of the startup costs, and don't guess at what these things cost. Have a look into it. Have a look at what it would cost to get a van if you need a van, or have a look around websites where you can compare insurance to try and understand, right, what am I going to be needing to pay in insurance costs. There's loads of websites where you put in, I'll be honest, quite a lot of information, but in the end you can get a quote before you go ahead and buy it, and get lots of different options. So you got no excuse to try and understand costs such around things like insurance. Then you obviously add those costs up, and that should bring you with a number. And is that number something that's reachable, attainable for you? Are you able to fund this yourself? If not, how will you fund it? Which of these options do you think will be applicable for you? If in all scenarios, I'm, as a business advisor, I'm incredibly risk averse. I would always try and as much as possible minimize your startup costs. It's the term is bootstrapping. It's essentially starting as small as you possibly can, on the smallest budget, on the smallest amount of resources you possibly can, and using that as an opportunity to first test your product and see if the customers come in, see if it is essentially a viable idea. And then once you have customers, or you have a lot of interest in your product, that's when you can understand, right, I have evidence that people want this, and now it is a safer time to put more into this. In all cases, I would always try and just minimize the costs initially. So, for example, if instead of buying a van with a huge lump sum payment at the start, maybe work towards renting a van to begin with, or essentially just making it so you don't have this huge payment, you have one small payment, and then you see how it works out as you go along. So in every case, in everything you've written down on this this list of startup costs, especially if that amount is beyond your reach, assess everything on that list and think, do you actually 100% need it, or can you start without it? Is this something that you could maybe buy down the line once you've established the business a bit, and once you're able to put some of the income from the business back into it to afford this sort of equipment, or these costs, whatever they may be? Or are you able to start without them? So understand what is the minimum you need to start the business, and how are you able to cover those costs? Essentially, you can't start the business unless you can fund the startup costs. There's no way around it. So those startup costs, whatever they may be, need to be within your reach. So yeah. One thing I would ask you to have a go at now, and I think everyone should do this at the earliest point possible you can before starting your business is to write down a list now of your startup costs. So this can be of your startup costs. So this could be in Excel or just on a piece of paper or just on a Word document. All it needs to be is a list of what items you need to get you to trading. You can also include in that list items that you already have, but what do you need in order to get you to the point of being able to trade? As I say, some examples of these startup costs could be insurance, material for stock, stationery, equipment, tools. It may be premises in some cases, things like that. What is required in order to get you to the point of starting? So pause the video here, have a go at doing that, and see where you're at. Right, so next up, we're going to be talking a bit about pricing. There are two main pricing strategies. So we have cost plus strategy, and we have value-based strategy. So cost-based strategy is essentially you understanding the sort of the cost of making the item, adding a markup to sort of be the profit that you expect from the item, and sort of operating in that way. To give you an example, so say you are a jeweler and you want to make, and you're making necklaces, your cost plus strategy in terms of pricing would be understanding, right, what is the cost of each of the, or all of the materials that I use? So how much do I spend on beads? How much do I spend on, string or wire or anything like that? Now, a very common thing to forget when you're trying to understand the cost of making something is the cost of things like overheads. So overheads include things like the rent and the cost of utilities in a building. So make sure that you understand that the actual complete cost of production, as well as another cost you may want to consider is the cost of your time being put into the production of it. So if you're spending 5 hours making a necklace, you need to also factor into the cost of making an item 5 hours of at the minimum wage. So that is another cost that you need to consider. And then you add a markup onto that cost, which is essentially your profit. And this is, this can be quite a competitive way to price items. It does result in a lower, more competitive price a lot of the time. However, yeah, it's very easy to forget certain costs in this strategy. But it all depends on the market you're aiming at, really. If you're aiming for sort of the lower cost market, then this may be the right one for you. The other strategy, though, is called value-based, and this is more based on what the customer is willing to pay. So it's far more dependent on things like your branding, your sales technique, your ability to persuade the customer of the value of what you're trying to sell, essentially. So there's a lot more potential to make more money when you use a value-based strategy. However, and it's more closely based on, as I say, what customers are willing to pay, which might be based on as well analyzing competitor pricing to understand their willingness to pay. However, if you do that, if you use this strategy to base it and base your sort of base your prices on what are people willing to pay compared to, and you use your competitors to try and understand that, you may not cover your costs because the competitors may be undercutting you or charging or be able to charge lower prices. So it wouldn't take into account your personal situation as much as a cost plus strategy. However, yeah, this does offer some scope for you to charge a lot more for your products. Again, that could be great because it's always better a business is sustainable when it charges a reasonable amount for its goods. It can keep going. However, if you may lose some customers that aren't willing to pay that much, that are wanting to pay on the lower end of things. So it does take a bit of essentially research and understanding of your customer base to understand, right, what are they willing to pay for it. And yeah, it is very much reliant on what the value of a product, the value that you can persuade a customer your product has. I mean, one thing to keep in mind as well when you're pricing, it's such a common, I think it's a very common thing for new businesses, especially, to, when they're pricing their goods and services, to try and undercut everyone else, or their competition. They see that as an easy sort of way into the market, and to an extent it is, but as I think I've said before, be careful doing that. It's not sustainable, and you need to make sure that the price you're charging is making it worth your time to sell. And the less value you put on the product, the less value the customer's going to put on the product. Sometimes as well, I think that customers sometimes are looking for a higher price in order to be persuaded of the value of the product. So, for example, I always give this example of me looking for a present for my sister's 30th birthday, and I remember I went to the shop and I saw this £5 bracelet, and I thought, that is perfect. That's her. She would absolutely love that. But it only cost £5. I can't get my sister a £5 bracelet for her 30th birthday. So I ended up getting a different one that was probably more expensive, and probably she wouldn't have liked as much as the other one. But I did that because I felt I needed to be persuaded of the value of it. And sometimes if you price it too low, people will just be like, oh, it's cheap and it's tat. I think sometimes the price can be higher, depending on, again, what value you can persuade the customer that what you're selling has. So next up, we're going to talk a little bit about cash flow forecasting. So any business is not necessarily going to make just a flat line of sales throughout the year. It's going to fluctuate. There'll be going to be times when you're doing well. There are going to be times when sales aren't doing so well at all. What a cash flow forecast is about trying to predict when the money is coming into your business, and this can help you anticipate cash flow challenges, which are incredibly important, especially with a new business. It's one of the bigger reasons that businesses in their first year or so fall flat, because it's not necessarily because they're not doing the work or they're not getting jobs. It's the cash flow through the business. It's being able to pay bills on time within your business, and buy the stock you need to in order to cater to demand. So what a cash flow forecast does is it's you essentially making an educated guess as to when the sales will come into your business and when they won't. And this is something that is informed by market research, so hopefully something you can learn from competitors, trying to understand when they get their sales in and when they don't, and when's quiet for them. It's also something you could kind of use common sense for a little bit. So, for example, if you were running a gift-based business, you'd expect you to get more sales around Christmas or around holidays such as like Valentine's Day or Mother's Day or all these sorts of things. So essentially, it's important to essentially, no one has a crystal ball and no one knows exactly what's going to happen. This pandemic is a prime example of that. Who could have seen this coming? And it's affecting businesses quite badly all over the country, having to close, all sorts of stuff. So this is on no one's cash flow forecast a year ago. No one could have seen this coming. But this is basically our best guess, our best educated guess as to what's going to happen. But yeah, you can't expect 100% accuracy. But what you can do is, as the business progresses, and you get past your first year of trading, you get past your first 2 years of trading, you can then use the data that you've collected from the sales throughout the year to understand what to expect going forward. So you may have predicted a lull during January, but you may find actually when it goes into practice, you get loads of customers during January because maybe your business is suited to, I don't know, stuff that's what things in demand at that time. Say it's colder than usual and you're selling woolly hats, So it's in essence, it's you trying to understand, right, when is the money going to come in, and always updating that information based on data you get throughout running your business as you go along. But I'll be honest, before you get started, it's much more of a guess, of a prediction, and that relies a lot more heavily on market research. So here's an example of a cash flow forecast. So as you can see, we've if you look at this table here, they've outlined all of those letters at the top stand for the months of the year, and in each month of the year, for this business, it's been predicted, again, an educated guess as to when the sales would be high, when they will be medium, and when they will be low. So that's what H, M, and L stand for on the left: high, medium, and low amounts of sales. And this is a guess. This business is a gift-related business where the sales go up quite a lot in the run-up to Christmas. They really sort of go down quite heavily during January, but they peak during holiday seasons, as I said before, like February, like Valentine's Day, or April, like Mother's Day, all that sort of thing. And yeah, so this is, as I say, an example of someone having a go at creating a cash flow forecast. Now, what I'm going to suggest is everyone now try and do this yourself. Try and, for your business, make up this table and make an educated guess in your first year of trading. And it might not start in January, maybe you're going to start in June. So just whatever works for your business, start it wherever you think your business start date will be. If you've already started trading, then maybe you could use the information you already have to try and inform this. And try and create a cash flow forecast for your business. So draw out this table and put a cross in every month to indicate whether you expect high sales, medium sales, or low sales during that time. So yeah, pause the video now, have a go at that. Okay, so hopefully you're back now and you have a chart drawn out for your business which captures in every month whether you expect sales to be high, medium, and low. Now, what you can do if you want to take this a step further and you want to try and understand what the potential income is to your company during this time is you can, let me just get the sheet I prepared earlier. So you can now, again, this is an educated guess, we're not going to know for absolutely certain, but essentially have a think about what is your average price of a sale. How much would you charge on average? So you may have a product that you sell that's worth £100, you may have a product that's worth £10, in which case your average sales price will be somewhere between those two numbers depending on how many you sell of each. Just to make the numbers easy, I'm going to say for this example business the average sale price is £100. Now, so I'm going to say now you just make an educated guess as to how many sales do you think you would expect in an average month where you are doing really well, you know. So as I say, maybe in a gift-based business, this is December. When you've predicted essentially a high number of sales, how many sales do you think that would be? So with this business, just I'm going to say 10. Oop, nope, that won't work at all. 10. And then I'll say maybe half that for a medium month, and maybe in a low month, not doing so well, maybe January, I'll say 1. So in this column, we'll put our average sales price, which will be, in this case, the same for each instance. And then here we calculate the value of the sales by multiplying those two together. So this would be £1,000 on a high month. In a medium month, you'd expect £500, and in a low month, we expect £100, and then we transfer that to the sales forecast in order to try to make the beginnings of a cash flow forecast. So here I've transferred and color coded the sales forecast from earlier. So we have high sales around Christmas time, going lower in January. Essentially, I've just brought it over to this format. So now in these columns we can put in what money we expect to come into the business during these times. So in February we're expecting high sales, so it'll be £1,000, medium in that month, so 500, back to 1,000, not dollars, we're not in America. Back to low, 100, medium would be 500 every time. Let's just save some time and copy and paste that. Boom. Go. And then £1,000 in each of these. And, you know, that is the beginnings of a cash flow forecast for your business. That is the beginnings of understanding what money you could expect to come into your business throughout the year. And it's not going to be 100% right because no one has a crystal ball, but that is a good starting point. And I'd definitely recommend just having a go at that in your spare time to sort of understand where your business is at and what you can expect from it. So, yep, there's an example. Let's continue on, shall we, to tax. Okay, so I hinted we might talk about tax a bit earlier on. A lot of numbers on this screen, but we can work through it a bit at a time, and I promise it becomes simpler. This is the instance of a sole trader. So, as I say, the simplest instance of being self-employed, you just registering with the government as self-employed as a sole trader. And this is how tax works for you if you're a sole trader. You and your business are essentially the same person, the same legal entity. And how it works is everyone has a tax allowance, a personal tax allowance of £12,500. So you can earn that much before being taxed. Now, to work out how much money you like your total taxable income, what you do is you have your income from the business, so that's here in green. So say your business makes 20 grand in over the course of a year. Something to note is that as a sole trader, your tax year goes from April to April in a year. So say your income over the course of that April to April year is £20,000, and then you would minus that those business expenses. Now, business expenses, they are any money you spend solely for business purposes. So the money you spend in order to make that income. So, for example, some examples of business expenses can be the money you spend on stock, the money you spend on insurance, the money you spend traveling to networking events or buying tickets to networking events to try and, you know, sell your product or to try and get the word out there or market yourself. Money solely for business purposes. You can also, in some cases when you work from home, and God, who isn't working from home at the moment, you can also charge a percentage of your monthly bills as a business expense. Now, this doesn't mean you get that money back, but it means it's money off the total amount of money you're taxed on. So you take your income and then you take away your business expenses from the business. So in this case, we have an example where you've made £20,000 from the business, but during the course of the year, you've spent £3,500. So in which case, your taxable income is £16,500. One take away the other. Now, so this is the amount that you'll be taxed on. But as I've said before, you have a tax-free allowance of £12,500. So anyone, if you make £12,500 over the course of a tax year, you don't need to pay any tax on that amount of money. However, what you do need to do is that doesn't mean that you don't have to file a self-assessment tax return, because you still need to tell the government these two numbers. You still need to tell them, yeah, I haven't made enough money to be taxed, but I made this much money and I spent this much money to make it. So anyway, here we have £16,500. Now up to £12,500, where we pay 0% tax, as we can see here, and then any amount, well, above that amount, up to £50,000, you are taxed at a rate of 20%, which is the basic rate. After that, if you make over £50,000, the tax goes up to 40%, a higher rate of tax, as you go. So, in this example, we have, as I say, a taxable income of £16,500. Now, to work out how much tax you would pay as a sole trader if you took in £16,500, the first thing you do is you first calculate, essentially, you take off £12,500 because you are paying 0% tax on that much. And then any amount between that and £16,500, so essentially £4,000. I mean, to be pernickety, we've put £3,999 because you start paying tax at £1 past 12,500, but essentially the difference between 12,500 and 16,500 is £4,000, and that is taxed at 20%. So to find out how much tax we're going to be paying, you multiply that amount by 20% by 0.2, and that leaves you with £800 as your tax bill for the year. Now it's very important to know that as you go along, because that tax bill when you're a sole trader, when you're self-employed, is not like when you are employed and you don't pay it as you go along. So that comes as one big bill when you fill in your self-assessment tax return. So that's why it's so important to, as you go along, understand, right, I'm expected to, I think this year, I think I'm going to make, this much money. And so in which case I think I'll need to pay this much tax. And so I'll have to be able to put that aside as I go along. It's very important that you're not sort of surprised by that bill when it comes in at the end of the year. Essentially, yeah, don't let it take you by surprise. Always try and have a good understanding as you go along of the money coming in and out of your business, so you can predict that tax bill at the end of the year and you're not surprised. Okay, so that's how tax works when you are a sole trader. Right. Oh no, we're doing an example. Oh hey, yeah, no, we're doing an example. So let's. Oh no. Okay. I'm going to trust everyone was honest and pause the video there. So essentially, you have an income of £25,000 and business expenses of £6,000. So I'll essentially take as much time as you need. There's no point in me timing you. But have a go at this calculation and try and work out how much tax you pay. And yeah, I would try and do it first without zooming forward to see the answer, because it's much more effective to help you learn, even if you get it wrong the first time. So yeah, pause the video here, have a go at that. An income of £25,000 into your business and a business expenses of £6,000. Give that a go. Okay, so here's where we start our calculations to try and work out how much tax you will pay. So first of all, what we do is we work out our taxable income by working out first our income, which is £25,000, as well as our business expenses, taking one from the other to understand your taxable income. Now that leaves us with £19,000. So how much tax will we pay on that? Well, first we need to take off £12,500 off that, because it is taxed at 0%. And then the taxable income between £12,500 and £19,000 is essentially £6,409, and you tax that at 20%. So you multiply it by 0.2. That's £1,300 tax to pay over the course of the year. So yeah, I hope everyone found that kind of okay. If you want to have another go, or please feel free. Or if you want to, if you have any questions, please feel free to email us at bss@pne.org. Again, if all this confuses you and you numbers aren't your thing, and this stresses you out more than anything, as I've said in the past, sometimes an accountant can pay their way in the amount of stress they save you, and they also can sometimes just pay their way in the amount of money they can save you through being able to understand, through their understanding of the tax system and things like that. So okay, we've covered an example of a sole trader. Now let's move on to a limited company. Now a limited company is a little bit more complicated. So first of all, you have the company's income, and you minus the business expense. So this is the company. This is the company's this is the money coming into the company's bank account. And how this works is you have the company's income, and then you minus business expenses from that amount. So it's the same as previously. However, this company, the business expenses of this company include your salary and your wages. So you take that out of the amount the amount of income the company takes in, and that is the total taxable business income. So that is the business's what the business is going to be taxed on. And that is taxed at a rate of 19%, which is corporation tax, which means in essence, it's, sometimes, better to not leave loads of money in the company because you'll be taxed on it at 19%. So let me just have a quick look. So yeah, so multiplying that by 90%, the total taxable business income will tell you how much that business will be paying as tax. So as an example here, a private limited company takes in 30 grand, but it has expenses of £22,500, and those expenses will include the wages of people working for that company, including the director. And then it will be left with £7.5 grand after that in the business's bank account, which it will be taxed corporation tax, which is 19% on. So £7,500 times 0.19, 19% equals £1,425. Now, this doesn't mean that your salary isn't taxed at a normal rate, but this is what the company does, like a separate tax return, and you do your own tax return as the director of the company. So yeah, let's have a look at an example. And essentially, you as an individual operate as a sole trader, so the wages coming out of the company to you have the same rules as a sole trader. So you get £12,500 tax-free allowance, and then you pay tax after that, 20% up to 50 grand, 40% after that. But your business, additionally, any money left in the business as a limited company gets taxed corporation tax at 19%. Okay, so here's an example. So your limited company has a turnover, so that's an income, of £35,000 and business expenses of £26,000, and that includes a salary, so money that you take out of the business, of £20,000. So the business has spent £20,000 on your salary and £6,000 on other business expenses. So have a go, think about what can the business expect to pay in corporation tax, and what can you as an individual expect to pay on that salary of £20,000. So yeah, pause the video here, have a go at it, we'll have the answer in a second. Right, let's have a go at this, shall we? So, as a business, you have the income, the turnover into the company, minus expenses, which includes the salary, of £36,000. No, hang on. £35,000. Why does it say 36? Oh no. Okay, this is wrong. Let's change this. Okay, so imagine this says £36,000. Sorry for the confusion. £36,000 minus £26,000, and that's £10,000 taxable income. Because yeah, you take the turnover of the company and you take away the expenses from the company, and this is the money left in the company's bank account after they've paid their wages. So how much tax do they have to pay? 19% of £10,000, which is 0.19 times 10,000. Equals £1,900 tax to pay, and so that's the company's tax bill. Now you, as an individual, have taken a salary of £20,000. It is possible actually to, within a limited company, set up PAYE, so pay as you earn tax. But this is just an example of if you either way, you'd need to pay this amount of tax over the course of a year. And how do you work that out? You take your income, and then which is £20,000. You don't have to pay tax on £12,500 of that, so that leaves you with £7,500 that you pay tax on. So you multiply that by 0.2, £1,500 tax to pay. Okay, cool. So I'm just gonna talk a little bit about a limited company. As a limited company, another thing you can do that you can't do as a sole trader. So as a limited company, it is possible to also take dividends from your company. So what dividends are they are like lump sums of money that you can't take out like on a regular basis, like probably like 2 times a year is probably the limit. And what it is you can you have a tax-free allowance up to £2,000 that you can take out as a dividend. So up to £2,000 you don't pay any tax. That a director can take out of the company, and you can also, and then you can take out a larger amount of that would be taxed up to I mean the maximum is about 9% up to a certain amount for the most part. So the advantage of this is, yes, you get charged less tax. The disadvantage is, you can't necessarily always afford to just take out big lumps of money rather than have a stable drawings throughout the year. So it also, these dividends, the money being taken out of the company can't put the company at risk. You can't take out £10,000 just before a big bill is due from the company that puts it in jeopardy. So a very tax efficient way to operate a limited company would be to, as a wage, as drawings from the business to yourself, essentially take your tax-free allowance, so £12,500, and then, if possible, although it's very likely, in lots of situations it isn't possible to, just take two big sums throughout the year rather than a steady income. You could take the rest out as dividends, which have a lower rate of tax. That's an option, and up to £2,000 are tax-free, and you can also take. If you have multiple directors in the company, they can also each take a dividend. So something to consider. Again, also worth talking to an accountant about if it's going to be worth your while, just to get the lowdown on it and how to do it. But yeah, that's something to know about dividends within a company. Right, so moving on. Here's some frequently asked questions about self-assessment tax returns. First of all, what are the deadlines for paying your tax? Essentially, over the course of the year. So as a sole trader, your tax year goes from April to April, to be specific, the 6th of April the previous year to the next year, 5th of April. And then you have to submit your tax returns and make the payment by January 31st the following year. So you do April to April, and then the following January 31st is your deadline for paying that tax. Now, with a limited company, your financial year is dictated by you. So essentially, when you decide to start trading, dictates when you start your financial year. And then your tax return is due 9 months after the financial year ends. So, if you decided if you just wanted to keep it simple and say, right, we're going to start January 1st and our tax year will just be January 1st to December 31st, then your tax your sort of tax return will be due 9 months after that, so around September time. So yeah, those are the deadlines involved. And also, so I've mentioned already business expenses. There are certain things you can charge as business expenses, certain things that you can't. The business expense must be wholly and exclusively for the purpose of running the business. So, for example, if you had a car that you sometimes use for personal reasons and you sometimes use for business reasons, you can't claim that car solely as a business expense. It would have to be partially a business expense. Now, if you use that car and you had to have business insurance on it, and that meant that your insurance increased by £5 every month or something like that, that £5 could be applicable as a business expense. So it needs to be wholly for the purposes of running the business. Things that can be included as a business expense include things like office costs, travel, clothing, materials, premises, marketing, training costs. Now, one thing to note as well, this also, I think I've referred to this already, but you can, if you work from home, also claim a certain percentage of your household bills as a business expense. Now, this doesn't necessarily mean that you get it free. It just means that it just means that you get taxed on a smaller amount, so you don't end up paying tax that you don't need to pay. Okie dokie. So Well, here's where I'd usually throw this question to the audience and ask, what do you think this number means? There's a very limited audience here, so I'm not I'm not going to ask that. But 5.8 million is the number of small businesses that are in the UK. And if you pursue wanting to start a business, then there's going to be one more added to that. And I just want to point out that starting a business can be hard. It's in most cases very difficult. It's not the easy option by any means, and it can be very easy to feel overwhelmed by the amount of information you need to take in to sort of understand how to essentially run a business, and how not to sort of fall into pitfalls that may come along the way. I just think it's important to know that everyone needs to learn before they start a new thing. Every successful business that's already out there and already sort of competing has at one point had the same amount of knowledge as you have now. Like essentially, and maybe even less. Like essentially, everyone is on a journey. No one knows everything yet. You can just do as much research as you can in order to try and get to the point where your business has the best chance of success, and we're here to support you in that throughout the lifetime of your business. And if you want to, you can visit our website to see other support we have on offer. So that's pneenterprise.org. There is our inquiries email, bss@pne.org, and you can also reach us on social media. That's our Twitter handle, PNE Enterprise. We're also on Facebook if you want to give us a follow or a like. So yeah, thank you so much for listening. Thank you for your time. Sorry this couldn't be in person, but what can you do? And I hope everyone's staying safe out there and washing your hands. But thanks for listening, and bye for now.